We are covering these 8 top actively traded stocks that are bullish today. Wayfair Incorporated, through its e-commerce platform, offers a massive range of furniture, decor, housewares, and home improvement products. The company serves a pretty diverse crowd, from budget-conscious households making $25,000 a year to high-income shoppers and even business professionals furnishing offices. Their portfolio includes well-known lifestyle brands like Wayfair, All Modern, Birch Lane, Joss & Main, and Perigold, as well as their own in-house labels like Three Posts and Mercury Row. While the U.S. remains their core market, they also have a presence abroad through Wayfair CA in Canada, Wayfair Co.uk in the UK, and Wayfair IE in Ireland. So what's moving the stock? Wayfair just got a little bit of wind back in its sales today, jumping 3.83% on the day, with volume hitting around 19 million shares, which is well above average. This bounce comes right after the stock was scraping its 52-week low, so the timing wasn't a coincidence. The catalyst? A positive development regarding the Vietnam tariff situation. There's been concern among investors that tariffs on imports from Vietnam, where a significant chunk of Wayfair's supply comes from, could further pressure margins and complicate their already stressed cost structure. But with that threat seemingly easing, at least for now, investors are breathing a small sigh of relief. It's not a total game changer, but in a market that's been pretty unforgiving toward e-commerce names lately, especially ones with softening demand and high logistics costs, this kind of reprieve matters. It's a reminder that Wayfair's story isn't just about demand trends. It's also about the macro environment and trade dynamics. If those external headwinds lighten up, even a little, it can have an outsized impact on the stock, especially when it's trading near beaten-down levels. For investors, today's move isn't necessarily a green light, but it's a decent signal that the market is still paying attention to the upside when it shows up. Target Corporation, one of the biggest names in general merchandise retail, is the kind of place where you can grab groceries, pick up some new throw pillows, stock up on beauty products, and still find a cute outfit on the way out, all under one roof. They run close to 2,000 stores across the U.S., most of them massive in size, and their digital platform, Target.com, extends that shopping experience online with a wide assortment of both in-store items and exclusive third-party offerings. Their private label brands like A New Day, Cloud Island, and Favorite Day have become household names, helping Target deliver style at affordable prices while keeping margins solid. Now let's talk stock action. Today, Target closed at $95.72, up 1.53%, which may not sound huge at first, but in context, it's kind of a big deal. The broader market was getting slammed, with the S&P 500 and NASDAQ both down more than 5%, so seeing Target move up while everything else was in the red definitely caught some attention. It's even more interesting when you realize Target's been under some pressure lately. The stock's down over 17% in the past month. So what's behind the move today? It looks like investors might be starting to sniff out a value opportunity. The stock's trading at a forward PE of just over 10, which is well below the industry average. That kind of discount tends to attract long-term buyers, especially when the business isn't fundamentally broken. Sure, near-term earnings are expected to dip. Analysts are projecting a drop of around 12% in EPS for the quarter, but full-year expectations are still showing modest growth in both revenue and profit. Basically, while the last month has been rough, today's bounce could be early signs of a sentiment shift. If Target can post decent numbers in the next earnings report and show that demand is still holding up, even in a tricky retail environment, we might be looking at a stock that's bottoming out. It's not a flashy turnaround yet, but it's the kind of name investors like to keep in their watch list when the market's this shaky. Sunrun Incorporated is a leading player in residential solar and home energy solutions in the U.S., focusing on designing, installing, and maintaining solar systems for homeowners. They don't just sell the panels, they own and operate the systems too, giving customers access to clean energy through long-term contracts, typically 20 to 25 years. Alongside solar, they also offer battery storage, EV chargers, and other home electrification products in select markets, all aimed at helping folks take more control over their energy use and costs. Now, Sunrun had a pretty strong day. Shares jumped 6.07% with around 16 million shares traded, which is definitely well above their normal volume. And in a market that's been a little rocky lately, especially for growth and renewable names, that kind of move stands out. There wasn't a single headline driving the spike, but a few things are likely helping here. First, solar stocks in general tend to move when there's a shift in sentiment around energy prices or policy. So if investors are anticipating any favorable regulatory signals, rate cuts, or even just stabilization in the cost of capital, names like Sunrun tend to catch a bid. Also, we're in a moment where clean energy stocks have been beaten up over the past year, and any signs of bottoming or value hunting can trigger sharp upside moves like this one. Sunrun's model does rely heavily on financing and long-term contracts, so higher interest rates have been a headwind. But if the market's starting to feel like rate cuts are back on the table, or at least that the worst is behind us, that gives names like Sunrun more breathing room. Add in growing demand for home electrification and backup storage, and you've got the kind of long-term trend investors want to be early on. Today's move might not be tied to a major announcement, but it does suggest there's some renewed interest coming back into the stock after a tough stretch. It's definitely worth keeping an eye on to see if this is just a short-term pop or the start of something more sustainable. American Eagle Outfitters Incorporated is a global clothing and lifestyle retailer, best known for its American Eagle and Aerie brands. They sell everything from jeans and casual wear to intimates and activewear, both online and in stores across North America and beyond. They also own Todd Snyder, a premium menswear line, adding a bit of elevated fashion to their mix. The stock jumped 4.79% today with about 15 million shares traded, and there are a couple key things driving that move. First, investors are reacting to the news that AEO will be paying out a $0.125 per share dividend later this month. With the recent drop in share price, down 36% in the last 3 months, that dividend now yields about 4.6%, which looks pretty solid compared to the rest of the retail space. And the good news is that earnings still comfortably cover the dividend, so it seems sustainable for now. But maybe the bigger story is the tariff situation. Earlier this week, retail stocks tanked on fears of a steep 46% tariff on goods from Vietnam, a major manufacturing hub for clothing brands like AEO. Today, though, news broke that Vietnam is pushing to eliminate those tariffs entirely through negotiations with the U.S., and that completely flipped sentiment. It's not a done deal, but even talk of backing off the tariff threat was enough to lift a bunch of retail names today. So yeah, AEO's rally looks like a mix of relief and value. The stock's still beat up, but with a solid dividend and some macro pressure possibly easing, it could be a name to keep an eye on, especially if you're looking for value plays in retail. Pacific Biosciences of California Incorporated is a life science tech company that builds cutting-edge sequencing systems for researchers tackling complex genetic questions. They're known for their hi-fi long-read sequencing and their newer sequencing by binding tech, both of which help unlock insights in areas like human genetics, cancer research, microbiology, and more. Their instruments like Revio and Sequel IIE allow scientists to read DNA with impressive accuracy and depth. Now, PacBio was up 3.36% today on about 12 million shares traded. And while that might not seem like huge news at first glance, there's something quietly meaningful going on behind the scenes. The company just handed out a sizable stock option package, over 340,000 shares, to their new CFO, Jim Gibson. That's a classic inducement grant, basically a big incentive to get a top-tier exec on board, and it tells us a few things. First, this is a vote of confidence. Bringing in a new CFO and tying him to a big stock award signals that PacBio is serious about turning things around or pushing growth. It's also a subtle message to the market. They believe their stock is undervalued and expect it to move higher over time. Second, for a company in a tough space like biotech, where cash burn, R&D, and long development cycles are the norm, having strong financial leadership can be a game changer. Investors might be looking at this hire and saying, all right, let's see what he can do, and pricing in a bit more optimism. It's not earth-shattering news on its own, but it's the kind of development that could mark a shift in narrative if PacBio can start showing progress with product adoption, partnerships, or cost control. For now, it's a small pop, but worth watching if you're tracking biotech plays with turnaround potential. Foot Locker Incorporated is a global retailer specializing in shoes and athletic apparel, with well-known brands like Foot Locker, Kids Foot Locker, Champ Sports, and Atmos in its portfolio. The company operates a large network of stores across North America, Europe, Asia, and more, and has been expanding its digital presence with e-commerce and omni-channel capabilities that blend online and in-store shopping. Whether it's ordering online and picking up in-store or buying online and shipping from stores, they're meeting customers where they are. Today, Foot Locker stock popped 1.53% with 10 million shares traded, so let's talk about why. The retail sector has been on a bit of a roller coaster lately, and Foot Locker is no exception. But despite some of those ups and downs, today's move seems to be a positive reaction from investors. For one, Foot Locker's been making smart moves in terms of expanding its online and mobile presence, which helps drive sales even when foot traffic to stores isn't as strong. And when a company can blend its digital and physical store experiences seamlessly, it adds a level of convenience that consumers love, especially in the footwear market where trying on shoes is still a big part of the process. The market's response today might also be tied to the broader optimism about the retail sector bouncing back after some recent challenges, or perhaps a few positive signals in their financials or store performance. With 10 million shares traded, that's a decent level of interest for the stock today. Investors are likely keeping an eye on how Foot Locker continues to manage that mix of physical and digital. If they can keep nailing that balance while navigating potential headwinds in retail, this stock might keep seeing some positive moves. If you're looking at it as a potential play, today's jump is a bit of a reminder that even in a rocky retail market, companies like Foot Locker that adapt well can still have their moments. Bit Digital Incorporated is a holding company that's making waves in the digital asset and AI infrastructure space. Based out of New York, they've got operations across the globe in places like the US, Canada, and Iceland, where they focus heavily on Bitcoin mining. They're not just about accumulating Bitcoin either. Bit Digital is diving into the AI sector with their Bit Digital AI platform, which offers infrastructure services for AI applications. Their strategy is to mine Bitcoin and sell it for fiat when it makes sense, depending on market conditions and their cash flow needs. Today, Bit Digital saw its stock rise by 2.28%, with about 9.38 million shares traded. That's a pretty solid jump, and investors are probably reacting to the company's position within the crypto mining and AI infrastructure spaces. While Bitcoin's market can be volatile, companies like Bit Digital are still drawing attention with their diversified approach, balancing Bitcoin mining with AI infrastructure, which is something that's gaining traction in the tech world. The trading volume today also shows there's some investor interest. 9.38 million shares is no small number, and it suggests that something caught the eye of the market. Whether it's confidence in the company's Bitcoin holdings or the growth potential in AI, the uptick in trading suggests investors are feeling a bit more optimistic about Bit Digital at the moment. For anyone keeping an eye on the stock, today's movement is a reminder that even with the ups and downs of crypto markets, companies like Bit Digital that have a hand in both digital assets and AI could be in a solid position to capture attention as those markets grow. It'll be interesting to see how the balance between mining Bitcoin and expanding AI services plays out in the long run. Novavax Incorporated is a biotech company focused on developing vaccines for serious infectious diseases, with a particular spotlight on its COVID-19 vaccine. They've got a unique approach, combining recombinant protein technology with advanced nanoparticle tech and their patented Matrix-M adjuvant to boost the immune response. Right now, their big product is the new Vaxovid COVID-19 vaccine. Today, Novavax saw an 11% jump in its stock price, with 9.22 million shares traded. This could be a reaction to some mixed news in the market. Analysts, like Steve Scala from TD Cowen, are maintaining a hold rating on the stock with a price target of $9. The uncertainty surrounding Novavax's regulatory path is definitely weighing on investor sentiment. The company is still waiting on the FDA's decision regarding its biologics license application, BLA, for its COVID-19 vaccine, which is developed in collaboration with Sanofi. While Novavax has addressed all FDA inquiries and believes everything is in order, the delay is creating some uncertainty in the market. Despite the waiting game, there's some optimism around the potential market for Novavax's vaccine. While full FDA approval might not dramatically shift the market for their product, it could still help solidify their position. The real focus seems to be on securing contracts, which management sees as more important for long-term success than just the approval itself. Healthcare professionals and payors are also optimistic, predicting that Novavax could capture significant market share by 2028. So, while today's price movement is positive, the market is still cautiously watching for that regulatory decision. The stock has room for growth if the approval comes through, and if Novavax continues to strengthen its market position. But for now, it's still a bit of a waiting game with some uncertainty hanging over the stock. Please subscribe, give the video a like, and watch more from our playlist. Thanks.